Hello, good afternoon. Welcome to Mutual Fund Corner on CNBC-TV18. I'm Vinnii Motiwala. Thank you so much for tuning in. Today, we'll try to understand the importance of multi-asset funds, and this especially in a volatile market. How does these multi-asset fund actually help you? What are their advantages, especially versus the traditional asset allocation? What are the key risks also these funds have? And these all answers is what we'll be getting solved from Nirav R Karkera, Head of Research at Fisdom, joining in with us to explain us what this is and explain us how these multi-asset funds work. Nirav, good afternoon. Thank you so much for joining in with us. Nirav, let's start by the basics. How do multi-asset funds help investors navigate this market volatility?
So, hi, Vinnii. Always a pleasure speaking. So, multi-asset funds have been the latest innovation brought about by the mutual fund industry. In fact, it attempts to circumvent all the limitations that the traditional hybrid funds had. Multi-asset funds are sort of more efficient and effective forms of hybrid funds. So apart from just equity and debt, multi-asset funds have the ability to take exposure to other asset classes like gold, silver, and REITs as well to reduce risk. Right. So, multi-asset funds have the ability to perform very well because of their multi-asset allocation across different points in time, even when equity is highly volatile or even fixed income is not doing well. That's when other asset classes take over and ensure that the journey to wealth creation is much more smoother and much more risk effective on a longer period basis.
Okay, right, absolutely. It does make sense. But, can they be actually a very good alternative to traditional asset allocation strategy, something like a 60-40 equity debt portfolio? Is that something that is advisable?
So definitely, I'd say hands down a multi-asset strategy could beat a traditional 60-40 strategy over a longer period. In fact, if we do a small exercise of the past 5 years and look at how a 60-40 portfolio would do, 60 into, let's say, a Nifty 500 and 40 into a 10-year long-term gilt versus, the category average of multi-asset returns, you'd see that in the former, in the 60-40 portfolio, a 10 lakh rupee investment 5 years back would yield around 18 odd lakhs at the end of 5 years. However, at the same time, a multi-asset category as an average managed to deliver up to 23 lakhs, right? So that's the stark differential. It's the difference of a 12% XIRR versus an 18% XIRR. So hands down, I believe that the nimbleness with which multi-asset allocation funds are managed, it clearly gives an edge over traditional 60-40 portfolios.
Okay, surely there is an edge over the 60-40 portfolio, given that one we're seeing in the comparison that you gave us also, the 5-year returns, surely so 12% for a 60-40 portfolio, while we've seen 18% approximately, this is ex-IRR return that we're seeing for the multi-asset. So surely a benefit that comes on that front. But Nirav, in a scenario where we're seeing of rising interest rates, fluctuating equity markets, how have multi-asset funds performed previously in such a scenario? Even at that time, have they managed to do well versus a traditional one?
So definitely. In fact, we have seen such a scenario across various occasions in the past as well. In fact, during the post-crisis of the GFC, that was in the period of 2010 and onwards. We saw it intermittently during 2014. In fact, we saw it right before the pandemic. These were periods when, equity returns were largely flattish, right? Even if negative, they were largely in the range of being flat. But during such periods, multi-asset funds have been able to deliver, low teens, which is pretty good considering the kind of environment where neither equities were making return nor fixed income was able to generate any sorts of excessive yields. So multi-asset funds have clearly stood out during all such periods as well.
Okay, so even during uncertain times, they've been able to manage risk. They've been consistently providing also good returns, even though we have seen market fluctuations or, the time period where there are interest rate cuts, interest rate movements coming in. Despite all of that, they've seen this performing well. Nirav, what are the best performing multi-asset funds that are there in the current market scenario? If you could give our viewers some help on that.
So there are quite a few multi-asset funds out there, and each one is distinct from the other. However, considering there are a few funds who have quite a track record to manage across various cycles and have built a sizable AUM. And I would say ICICI Prudential and HDFC's multi-asset propositions are definitely worth looking at. They have been time tested, they have been cycle tested, they have been able to hold up on a risk-effective basis very, very well. Of course, there are a few newer ones also that are good enough. However, we know that the past 5 years have been largely secular in terms of trend. So we are yet to see how does it hold up during times of extreme volatility. But having said that, HDFC and ICICI Prudential's multi-asset propositions are definitely good ones worth looking at.
Okay, a few of the names that have come in from Nirav on that front, where you can look at some of these good names coming in. But let's move on. And Nirav, how should investors actually compare and choose between different multi-asset funds? What is important, right? There are so many options. You have given a few names as well. So how does one actually pick from all these options that you have?
So while the basics remain intact, you must always know your fund manager, know your fund management team, look at the track record. But something that's very, very nuanced to multi-asset funds is to look at the strategies that these fund managers have played at the turn of various cycles and see how has it panned out going ahead. So it's not just track record, it's not just numbers and absolute performance in isolation, but it is in context of the cycle and the variety of strategies that the fund managers have deployed. You want to go with a fund manager who looks beyond the equity and debt also. You want the fund management team to offer exposure to silver and REITs also as and when required. Right. So I feel this is something which is very distinct from everything else, is checking out the allocation strategy and the tactical and nimbleness of execution of all such multi-asset strategies at different points in time, preferably during turns of cycles. Extreme peaks and extreme bottoms is when the fund manager's ability to deploy a multi-asset strategy is really put to test.
Okay, and Nirav, how should one actually consider investing in these funds? Are they better suited for and who should actually consider? Is it conservative investors or those who are seeking higher returns, diversification? Who is this for a investor? Best choice. Who should be the one picking this?
Often than not, most people believe that multi-assets and hybrids are meant just for conservative investors, but that's not quite the case. Because these mandates also have the ability to take significant exposure to equities as and when required, and even within equities, they can stretch throughout the universe of listed stocks, right? So, the actual objective that a multi-asset fund solves is for delivering risk-effective returns over a longer period. So any investor who has a certain goal in mind and does not want to experience a lot of volatility, if his objective is just to optimize across different markets, that he or she is at least beating the benchmarks, I feel multi-asset funds are a go-to fund for such investors. It has nothing to do with the risk appetite as much as it has to do with the investment objective of the investor.
Investment objective is more important than your risk appetite, and anyone can opt for it. It's not necessarily only a conservative investor should maybe be looking at this option. But what are the key risks that are involved in these funds as well? I'm sure everyone has the pros and cons, and every fund will have its pros and cons. So for a multi-asset fund, what are the risks that we are there that one as an investor should watch out, and how should they be evaluating them also?
The biggest risk involved here, like with most other funds as well, is the risk of that every asset class carries, right? So there are two types of risk here. One is in fact, three. One is the selection risk. Choosing the right instruments within whatever asset class you have selected as a fund manager, right? The second risk is the allocation risk. You always want to be over allocated to asset classes that are expected to do better. So that the allocation risk is the second one, and the third is the timing risk, wherein you want to stay invested in winning asset categories and winning securities, and you want to cut your losses short very early on in asset classes that are not really performing. So any sort of lapses on these three funds could result in bearing heavy on the overall portfolio's performance. So I would, I would narrow it down to selection, allocation, and timing risk. And this can be assessed by looking at the track record across these three parameters, back in time.
Okay, Nirav, on that note, we're going to actually slip into a very short break, viewers. But we'll come back and we're going to be discussing what should you be focusing on, growth funds or dividend mutual funds, what's an exciting option, all of that. So don't go anywhere. Welcome back. Thanks for staying tuned in Mutual Fund Corner on CNBC-TV18. We still have with us Nirav R Karkera, Head of Research at Fisdom. Now we're going to shift focus, and like I mentioned, we're going to talk about growth and dividend mutual funds, which is a better option. What should one be looking at? The difference between these two funds as well. And we'll try to understand all of this, what will help you create better wealth. Nirav, let's start with this topic for now. And what is the main difference between a growth mutual fund as well as a dividend mutual fund? Nirav?
So, the key difference between a growth plan and yes, can you hear me?
Yes,
Am
I can.
audible?
I can hear you. Yeah.
Okay, so the key difference between a growth plan and a dividend plan is the fact that a growth plan ensures that your NAV continues to grow and compound. So there is no intermittent payouts that are made by the plan. But in a dividend plan, what is done is that profits are typically paid out to the investor from time to time. So this is so like any other dividend, like we would all know in stocks, right? Even mutual funds allow the option to give out dividends on a periodic basis if the scheme makes profits. So this is the key difference between the two.
Okay. And Nirav, if you have to talk about it, what is the impact on returns and taxations? How is the difference there as well for both growth as well as dividend mutual funds?
So one thing is very clear that growth plans deliver a whole lot better returns, and due to the basic premise of compounding, right? If you do not keep taking your money out, every growth that your money has experienced only keeps compounding over a longer period in time. But however, when you start taking money out in the form of dividend, you're at any given point in time, you are invested at a level less than what it could have been potentially, right? So the IRRs are very different. Growth plans deliver phenomenally better IRRs, whereas in a dividend, the IRRs are much lower. Performance tends to become lower. Of course, it does offer a periodic liquidity, but it comes at quite a cost. And in fact, on a taxation front as well, if you were to redeem from a growth plan, you will be charged as per capital gains regime, which is pretty decent. For equity, it is 12.5% beyond the 1.25 lakh exemption, and the short-term capital gain is just 20%. However, on dividends, you are going to be taxed at your personal tax slab. So until and unless you are in the lower tax brackets, it definitely does not make sense to go for a dividend option, or unless you have a very hard requirement for periodic liquidity, no matter how uncertain it is, that's when you could, probably look at a dividend. Apart from that, from an IRR and taxation standpoint, both, I feel hands down, growth plan is the most ideal option unless you have a very specific need for dividend plans and you belong to a lower tax bracket.
Absolutely. So, Nirav, then my next question, I think the answer is that one should, for long-term wealth creation, go for growth mutual funds, right?
Unequivocally, yes, absolutely. I feel there are no two opinions about it.
Okay, so then when does this dividend, side of mutual fund actually make sense? Who should actually opt for this option? What sort of an investor is it, when you are post your 40s or something, that is when you should go for such options?
Even there, right, you can invest in a growth plan and opt for a systematic withdrawal plan, wherein your tax incidence is going to be far more effective because it comes under the capital gain purview, right? So if you are in the higher tax bracket, definitely, go for a growth plan after a longer period, then you take out a systematic withdrawal plan. That is a good option. But if you are in the lower tax bracket, which is effectively lower than the applicable capital gain tax, you can go for dividend plans. If you want a steady stream of income and you want to keep continuously taking profits off the table, that's when you can look for dividend plans. However, one thing, a word of caution is that dividends are not going to be very linear. The value and the periodicity could really fluctuate. So there's no form of certainty there. But yes, if you are an investor who likes to take profits off the table from time to time and your tax bracket is lower, I feel this is the most ideal case where a dividend plan would really suit your need.
Okay. And, just a clarification, right? So retirement plan, is that the time one should go for it? Like you're saying, you can go for systematic withdrawal. So then that is mostly during the retirement times or something that you want more on a tax efficiency basis, right?
Right, correct, absolutely. So even if if you're already in retirement, you may want to, probably start with a few dividend plans just so that you get some cash flow going. Again, there's no guarantee you will get it in whatever quantum you're expecting or periodicity, but you can get some cash flow going. However, you should plan it in a way that at least, at the earliest possible, you should be able to set up an SWP from a growth plan.
Okay. And, Nirav, is it important to choose this based on your financial goals, time horizon, and tax bracket that will come into play, right? If you have a short-term goal or a long-term goal, then how do you go? Depending on this, if I have a short-term goal, what does it make sense to go for? Long-term goal, what does it make sense to go for?
So, firstly, for a short-term goal, definitely asset allocation becomes all the more important. Of course, it is also for the long-term goal, but for the shorter term, you don't want to go all into equities, right? So, for shorter-term goals, you could probably diversify some bit of your portfolio into dividend schemes just so that you get periodic and, some sort of cash flow going to meet certain expenses, just as a support sort of a thing. However, from a long-term perspective, we believe it is absolutely imperative that you go for growth funds so that it benefits from the central premise of compounding over a longer period. You do not touch that money, you do not take money off the table. Every bit of money that is growing continues to double down and grow further in the years to come. So the compounding effect is truly experienced over the longer period only in a growth option.
Okay. Compounding is only in a growth option that you would get in. So obviously, it's much favorable if someone has a higher return or something that they are greedy on terms of returns, want returns, the best returns, then obviously wait out for compounding. And obviously, long-term would be a best strategy for you going there. But, Nirav, what is your recommendation for those who wanted to opt for, who have an regular income? What is the option that they have right now in these sort of funds? What should they be looking at?
So for regular income, like I said, SWPs are probably the best shot that you have. It is tax efficient. It gives you the flexibility to plan your cash flows. Let's say markets are not doing really well. You don't want to take money off the table. You want it to compound. You can pause your SWPs, right? So you have a whole lot more control over your cash flows in an SWP. So an SWP is clearly the way to go if you're looking for regular income.
Okay, SWP is clearly the way to go if you're looking for regular income. Nirav, this has been a very great chat that we have had with you. So, thank you so much for joining it with us on the show and, giving us your time, explaining us multi-asset funds as well as dividend as well as growth funds, which is the better option. What helps you save tax as well as, if you're looking for more returns, viewers, then obviously growth does make sense. If you're looking for, systematic withdrawal plan, some sort of that you want liquidity coming in every time, then Nirav has highlighted then dividend does make sense that yes, you can go for it. But that is when you just do not worried in terms of returns and you just want regular inflows coming in for the company. So that is the option coming in, and recommended to opt for a regular income is a systematic withdrawal plan. Only capital gains are taxed, unlike dividends, which are taxed at your slab rate. So yes, that is something that also you should be keeping an eye out on, and investors can decide withdrawal amount and frequency of amount as well in a systematic withdrawal plan. So that's the word coming in on this front. Thank you so much, viewers, for tuning in to CNBC TV18. It's a pleasure having you on the show and watching us the show. But with that, we're going to wind down this edition. Up next, you have Closing Bell, so don't go anywhere.